Hello, everyone, and thank you for joining today's webinar about the opportunities we're seeing in the wagering industry. My name is Michael Donohue. I'm head of distribution here at Waterhouse VC. I'm joined by Tom Waterhouse, our chief investment officer. Hi, Tom.
Hi, guys. Nice to be on the webinar.
Today, we're going to aim for about 45 minutes for the webinar. The first half will be a short presentation by Tom, and then we'll leave some time at the end for some questions, hopefully plenty of time. For those new to the fund, I think the first half of the presentation will be interesting for you. You'll get an understanding of how we're seeing the industry and also just the niche in the industry that we're focusing on and how we're going about our strategy. And if you've been following the fund for a while or you're an investor with us, the second part will be pretty valuable, I think, because we'll be talking a bit more about our latest deal, which is maybe the most significant deal and investment the fund has done to date. Hopefully everyone can see that and it's nice and big. Before I hand over to Tom, just an important disclaimer, this presentation is general information only. Any past performance mentioned is not an indicator of future returns. It's for wholesale investors only and only people outside of the US. And then last thing before we kick off, you'll see in the bottom right-hand corner of your screen, there is a little box that says chat. If you open that up, you can put your questions in at any time. Please put them all the way through the presentation. I'll start compiling them. And then when Tom's finished the presentation, I'll start reading them out to Tom and we'll get through as many questions as possible. And only your first name will be shown to the other attendees when you're asking questions. So please fire away. So Tom, I've got the 5-year track record up on the screen at the moment. We brought up that 5-year anniversary last month, which is pretty exciting, I think. The returns have been really good to date. We've compounded the fund at over 98% per annum for 5 years now. I think that's all well and good. If you're tuning in today, though, you're probably equally interested in obviously the historical performance, but perhaps more interested in what the next 5 years will look like, I think. I think that's why we're all joining today. So I think it would be good to hear from you, Tom, just on the background on the industry, the niche that we're focusing on, and then the strategy that we're actually implementing to take advantage of the opportunities.
Great. Thanks, Michael. And good morning, everyone. Look, I'll start off by just talking about the more broader market. The gambling market, obviously everyone's been gambling since the beginning of time. It's a large industry. It's a $1 trillion industry. And the way to normally access and get return out of that industry was to invest in the operators. So in the likes of William Hill and Ladbrokes in the UK, or Tabcorp in Australia, or Caesars and MGM in the US. But over the last 5 or so years, it's become tougher and tougher on operators to make outsized returns. And that's been due to increase in regulation, taxation, and advertising restrictions. So even in a huge opening market that's growing, like the US, which repealed PASPA in 2018, you've only seen one online operator there have 1 quarter of profitability since 2018, and that was FanDuel. They're spending huge amounts on advertising, $1 billion plus a year per operator, and they've got huge teams, staff, and so on. Yet to get outsized return and beat the market has been very hard if you just focused on those operators. And as background, the family's been in the industry for 100 plus years. As you know, probably know, I was an on-course bookie, had online betting business, tomwaterhouse.com, and then was the CEO of William Hill Australia's business. And it was a really interesting business. We had a team, 500 people in the team, 170 IT developers in Sydney, another 100 in the Philippines. And it really shifted in that time that I was operating that business from all about marketing and differentiate on marketing to differentiating on product, because it became tougher and tougher to have general mainstream marketing. The advertising landscape changed, TV transferred to digital, and operators started differentiating on products, really with the premise that if you can have a great product, customers will be attracted to sign up with you and you'll be able to retain them longer. They'll be stickier. So you'll have them a higher lifetime value, and then you'll have obviously more revenue that you can plow back into better user experience, acquiring more customers and so on. I saw with William Hill firsthand that to get a new product into William Hill, it was normally built by an external party, third party, and it was very hard to get into the William Hill ecosystem. We had hundreds of products from third parties trying to get into the William Hill ecosystem, and we were prioritizing. There'd be a fight internally with the team members and executive of which one we prioritize. And we usually release maybe 3 or 4 new products a quarter. And I realized, but once you're in the ecosystem of William Hill or a sports bet or a Caesars or MGM, you're actually very sticky because you're in the ecosystem. It's taken a long time to get there. And those third parties that supply a service, whether it be odds or whether it's providing the betting engine or the mobile application or some other tool, once they're in the ecosystem, it's quite hard to get them out of the ecosystem. And they get a percentage normally of gross revenue. So they're somewhat protected from the taxes. So to give an example, if you watch the NRL, those odds are normally provided by a third-party data provider. If you're watching the NBA, it's provided by, let's say, Sports Radar or Genius Sports. If you're watching horse racing, the odds are supplied by Racing and Sports, bet makers, maybe in the UK, a company called SIS, and so on. A lot of the data, the technology, the product is third-party supply. And so William Hill sold their business in 2018 to PokerStars. And I was, as part of that sale, I no longer was a CEO of William Hill. I no longer had a job working as doing that role. And I had a 2-year non-compete. And I thought, well, what am I going to do? I can't be a bookie. That's basically the only thing that I'd ever done. But I love the industry and I know the industry and want to stay in the industry and thought, well, I think there's an edge in understanding these suppliers because if you're an analyst at one of the big banks, you can probably analyze the P&L of a Tabcorp or a Entain or a Bet365, and they're quite similar. You've got turnover, gross win, product fees, taxes, and so on. Then you've got technology costs, headcount costs, marketing costs, and then you've got your profit and a whole bunch of other costs as well, but similar lines of the P&L. And whether a company should be trading at 8 times earnings or 10 times or 15 times earnings, an analyst at one of the banks can probably analyze that far better than I can. But a technology provider to one of those big companies, they're not mainstream known. And if one company is supplying esports data, like the odds for an esports tournament, is that product going to grow? And can that provider go from having one contract with Ladbrokes to having 50 contracts around the world? Well, that is very hard to know because normally the big betting companies don't talk about those third-party suppliers in their annual reports or when they're giving investor presentations. And the external market sort of looks at these large betting companies and go, well, they must provide all the technology and all the odds and everything end to end, but that is not the case. So I thought we had an edge in understanding that there are these suppliers in the technology layer and which suppliers have the best chance of getting into the ecosystem of these betting companies. And so I asked our best engineer at William Hill, who was working at Qantas at the time and had been developing a gambling product for 10 years in the space and was a genius. I said, look, I think there's an edge to looking at gambling product and the technology layer in the sector. I'm going to form this fund. Will you come on board? And he brought himself and some members, very, very skilled members he'd work with. And we started Waterhouse VC 5 years ago, really going, well, we're going to invest in the technology layer of the gambling sector. So that's the background of why we focus on that area. And what led to the fund is that we've got 3 pillars to the fund. The first pillar, it really came about, which has got all our return historically, and I believe we'll get our outperformance going forward. The first pillar came about through our first deal. And the deal was we saw a company that supplied racing data, and they supplied William Hill, and they supplied also the racing industry with racing data, and they had a platform they used to be a betting company, and they transitioned to being a B2B supplier. So we knew the business quite well. We invested $600,000 in the business, and we then, as part of putting some equity in, we negotiated to get an option to buy 19.9% of the company at an agreed price. at that date for 3 years. And that business grew. Obviously, US opened up. There were very low interest rates. There was a boom about online betting, and that business grew very, very quickly, both through increased revenue, but also because there was a lot of excitement about that part of the market. And our options suddenly became very valuable. And I hadn't done anything with finance or commerce since 20 years before at university, so I didn't have a great grasp on the value of options. But this deal that came off for us, we suddenly saw the value of what options could bring. And so we decided that we would change the fund and really focus, rather than making equity investments, that we would go around the world and try and find great technology companies that generated some revenue, that had 1 or 2 contracts, maybe in Eastern Europe or maybe in somewhere in Asia, that we thought we could expand and help expand into Australia, UK, US, and so on. But rather than putting large equity stake in them, we would negotiate to buy an option in those businesses. So our typical deal is we buy an option to acquire, if they're listed, 19.9%, if they're non-listed, 20% of the company at an agreed price today, and that option has a 3-year period. And why we think we have the ability to do that well is that we understand the space very well. The tech team's been building in the same industry for the last 10 years, very knowledgeable about how good the code and technology is. We have great insight into what the operators are looking for, what are the trends in the industry, where is growth. So when we do an option deal, we already have great insight that, that product is probably needed in North America, or that product is needed in Australia. We have a tech team that is able to understand, well, how hard will it be for that operator to integrate it? Because if it's going to be 2 years of development work, they've got a huge priority list. So, and we've also, because we've been doing it for so long, if the company needs to get funded, if they have us on board the register of having an option deal, they often have found it easy to get funded and expand if they needed to. We also have great insights into who they could go and speak to about expanding their team and ramp up the team. And so we bring benefits. Obviously, we buy the option, but we bring great benefits about being part of these businesses and really help them with the blueprint of where they can take the business from having 1 contract to 2 contracts to so on. I might give an example of what we do. So we look at many different businesses with, for instance, platform businesses. So if you want to start, let's say Michael wanted to become a bookie, he might do michaelbet.com, and he goes, well, I don't know how to build the tech, and I don't really know how to have odds on everything under the sun, but I think bookmaking is a growing area and I want to expand. And so we like finding businesses that can provide platforms, trading services, data feeds. We get approached quite often, all the time, by businesses. So we probably speak to 20 businesses a week, probably follow up between 2 and 5, and may not even do an option deal in every 100. So we're looking at lots and lots of businesses. We go to all of the gambling conferences around the world. So this year we've been from South America, North America, Europe, UK, Asia, Australia. Basically, wherever there's a gaming conference, we go. We're normally speaking at the conference, and then we speed date for 3 days, 15-minute meetings, meeting business after business after business. If we think they've got something unique, then we follow up, many calls, go and meet their business. Tech team comes in, analyze their tech, and see if we can come to an agreement on an option deal. So an interesting deal that just shows it's really the value of our team is that we were approached by a business that had done a token sale in 2018 and had developed some tech, and they'd run out of money to pay their developers in Vietnam, and they emailed in and said, look, we need some money. We need help capital raising. Do you want to invest? We go, look, we don't invest. If your technology is good, we may look at an option deal. I passed it on to our CTO. He looked at the tech and he said, look, for us to develop that tech in Australia would take 2 years, $12 million of Australian development cost. It's actually a really good piece of tech. For me, we see these businesses all the time. I would have no idea whether the tech was great, not great. I was probably wrongly dismissive that it was like, I didn't quite understand the token sale and that it was in Vietnam. But I went, okay, well, he thinks the tech's worth something. We went in, negotiated to get an option in that business to buy 20% of it at $1 million USD valuation. Then we, off the back of that, they were able to raise $2 million at $4.9 million valuation within a month of us doing the option deal. And then they were able to sell. We said, look, these are possible people that would want a great piece of tech that have been developed once you got the money in. They were able to sell that business within 5 months for $23 million US dollars. So our ability of understanding what's needed, why it's needed, and understanding whether it's good technology or not is very powerful. So we looked at that, and that's a good case deal. There's plenty of deals. We do lots of options, and like we've only had 5 come off in 5 years. So it's not like it's all the time happening, but that's sort of how we use the team and the ability of the team to analyze whether something is good or not. In terms of the options, we generally, because they're high risk in the sense that if that business doesn't get funded, it doesn't go anywhere. You know, it has to close its doors, and that's why it's needed. Or if we look at a business that's got one contract in Eastern Europe and not enough money to pay their developers to expand, they're high risk if you were looking at them from an equity point of view. And when we value buying the options, it's hard to get the option value very high. So the most we've ever paid for an option is $30,000. And generally it's a lot less than that to buy these options. But if we get them right, there's a significant payoff. And as I said, we've had several come off over the years. We've got all our return through this first pillar of the strategy, optioning up tech businesses, trying to help them in a way grow. We take no active role, but trying to sort of say, this is the blueprint of how you expand. And when they come off, they're obviously very lucrative. The most we've ever paid for an option deal is $30,000. We're a fixed unit trust in Australia. So every time we have a dividend or a gain, we have to distribute the gains, and we've had several years of great returns. So we distributed $40 million last year, $7 million last month to our investors. I think 3 years before that, it was $4 or $5 million back to our investors. We can't hold the gains; we give it back to our investors at the end of each financial year. At the beginning, they were great. This is fantastic. You're probably a one-hit wonder, but they've seen that we and our team, all we do is spend all our time trying to find option deals, and we love the industry and know the industry, and I'd be doing it for fun. I love looking at these businesses. So our investors said, well, look, actually, we want to keep putting the money back in. Not all of them, but majority of them. We want to keep putting the money back into the fund, keep finding option deals, and hopefully getting us great return. And so we were then sitting in a few years ago quite a bit of cash, because we don't need a huge amount to get the option. And if we're going to convert the option, they're generally in the money. And we don't go into any B2C. We don't go into any operators. So the reason why we sold that option in that tech platform is that they sold it to a person that was going to go down the B2C path. So we sometimes don't even convert the options. We sell the option, and we have not a huge need for the cash, because the options we're normally negotiating are not huge amounts. So what do we do with the people's cash that are in the fund? And that led to pillar 2 of the strategy. We thought, well, do we put it in, I don't know, bonds, gold, term deposit, just sit it there in cash? And all of those didn't quite fit with where we wanted to go. The family were the majority of the fund, and we had deployed for the last 10 years a strategy that we thought would be, our investors probably would have an appetite. We were not quite sure at the beginning, but we thought that this would be what we ended up doing would be a good pathway for us to go down while we were holding their cash. And what we have done as a family for 10 years is followed the 13F filings of leading funds around the world. So for anyone that doesn't know what a 13F filing is, they made it after the global financial crisis that any fund with over $100 million of US equities had to release a 13F filing every quarter, which outlined all the equities that they held, what proportion they held, what they've bought and sold, and so on. As you've probably heard Warren Buffett say a million times, it's very hard for any fund, and he'd be happy to bet, I think, any fund that they're not going to beat the index. And with that in mind, I was like, well, why not just put it in the index? But there's several funds that have beaten the index over the last 30-year period that are long only. So that are not buying and selling and hedging their position, that are long only. And so we as a family followed the 13F filings for the last 10 years and went to our investors a few years ago and said, look, we'd like to follow the 13F filings of the leading funds that are long only around the world. There's 16 funds that have outperformed the S&P over the last 30 years. We'd like to follow their 13F filings and their positions and apply a few proprietary factors to those 13F filings. So what we have an analyst here, two analysts separately doing it, where they go through once a quarter the 13F filings of those 16 best performing funds. It has to be over 1% position in those funds. So the funds are like Berkshire, Bridgewater, Third Point, Apollo, Tiger, and so on. They go through their filings. Any position that's over 1% of their fund, it has to be trading under 20 times PE, growing revenue greater than 20% year on year on average over the last 5 years, and very little debt. So we want to be an ultra conservative, low PE, but still high growth business that isn't impacted by increasing interest rates by having very little debt. So we applied those factors, went to our largest investors and said, look, this is what we want to do with the cash that we're holding. We're going to spend all our time. We're not going to actively manage an equity portfolio for you. We don't think we're out smarter than the market. We think these funds are smarter than the market, and we want to pick their most conservative positions that are still high growth. And we want to park the money here while we spend 99.99% of the time focusing on option deals. Investors said, well, that sounds a very conservative, good strategy. Let's go for it, and let's see how you go. And so we obviously followed that strategy over the last, since we started it. We've outperformed the S&P by 11.8%. We've done it with a Sharpe ratio of 1.09. Our average P ratio of our companies is 13 times. The S&P is trading at like 23 times. Our median growth rate's 27%. The S&P's median growth rate's 18%. So we're in much lower P ratio companies, still high growth, the only companies that are owned by those leading funds in the world. And we basically just want to park money in this strategy and perform in line and hopefully slightly better than the market, the S&P, but B, if it's a downturn in the market, that we outperform. So we want to be in a very conservative group of stocks and park the money there. And the reason being is that we believe that pillar one, finding options, gives us all our alpha, gives us our out return. We just want to be parked in, we don't want to be parked in cash. We believe that the strategy of 13F is a good strategy, that we'd be happy to park passive money anyway, but we park it in that strategy while we spend all our time focusing on the option deals. That strategy has performed very well for us. We think that worst case scenario, where a boring but good performing US equity strategy, but that we're going to be hard to beat against other US equity strategies. Obviously, maybe we never find any option deals anymore, but we're going to be hard to beat against US equity strategy because we hopefully keep finding option deals that give us that outperformance. The fund is made up, in terms of its net asset value, its NAV, is made up 98% of the 13F positions. And that's why we have monthly liquidity. So you can come in and out of the fund each month. And the reason being is because all the funds are in those equity positions. All of the options sit at cost in our fund. So we don't pay huge amounts for those options. They sit at sub 2% of the fund. So we sit in US equities, and that gives us liquidity, and the options sit at cost in the fund. But if any of those options come off, they give us our outperformance and return. And that's where we spend all our time. So that's the second pillar of our fund. Boring or steady, sturdy US equity strategy, waiting for us or while we focus on the area that we have the expertise. And then the third pillar of the fund is a recent pillar, is our deal with Racing and Sports. And Racing and Sports, obviously my background is in racing, and I'm very interested in data suppliers of the racing industry, and have known Gary Crisp and Stephen Crisp for a long period of time, and held them in very high regard, because they've been doing it for well over 25 years and supplying great data to the racing industry and to participants in the betting industry and bookmakers. And so been having long discussions back and forward, and I think it's a really interesting business from an equity position. But we have our strategy of option deals and US equities, and our largest position of US equities is sub 5% of the fund. So we're ultra diversified in the US equities, and we don't pay huge amounts for the option deals. If we suddenly start introducing that we're going and buying big equity stakes, well, then that changes the dynamics. It becomes more risky. And so even though we liked the business like Racing and Sport, it wasn't really in our remit to go and make a large equity investment. And talking with Stephen and Gary and Tim Olive, their CFO, is look, we want to be part of this business. We think it's very interesting, but what's a way that we can have an equity stake in the business, but also if we can create opportunity and see ways for you to grow, that we can have option long term. We came to an agreement which I think we're very pleased with, and I think they are also very pleased with, where we made an investment. We bought 2.5% of Racing and Sports just a few weeks back, and we have an option to acquire another 2.5% for 3 years, and then a further 10% option based on revenue milestones to buy another 10%. So for us, it's really exciting, and there's sort of three reasons why we really think it's an interesting business. And obviously all of these things you've got to execute, and there's one thing to have hopes that they're going to be great, but the proof's in the pudding of executing and doing it. But the thing that I like about it is that with our pillar one, our option deals, we have been very good at identifying companies that can potentially grow, obviously, because we've had quite a few come off. We've been good at seeing them raise capital off the back of us having an option deal. We've been good at helping them with this is great tech talent to find, or this is great team to find, and so on. So expanding their capability and helping with introductions. This is the person you should speak to, or this is how you go about it. This is the blueprint of how to expand. But the area that we have struggled in that pillar one, we haven't been able to fast track their ability to get into the product pipeline of the large bookmakers, because the large bookmakers have so many competing priorities. And even though it might be a great piece of tech, it's still a long process. And so we love the opportunity with Racing and Sports, that very switched on team, a team that's been shown their capability and been doing it a long period of time. Secondly, they've got an expanding data services, platform services, mobile app, and managed trading services. That area is expanding, and they are keen for us to present deals that we've looked at and option deals that we've looked at for them to be able to distribute. So that solves an issue for us in pillar one of finding these companies finding distribution. So they're very keen for us to help them as find deal flow, and we're very keen to find deal flow for them, because we want those businesses to get as far and wide a distribution as possible. And then we were really excited by Racing and Sports deal with Stake. Stake's one of the fastest growing betting companies in the world, and it's just amazing what those founders have been able to do to take on the incumbents and really be such huge operators. They're young, they're dynamic, great user experience, innovative marketing, and Racing and Sports has got a deal to provide racing data for them. And racing is such an amazing product because it's built for betting. It's high margin, it's high frequency, and it's a really, really great product. And the issue is that it hasn't been able to get distribution with these new up and coming operators, the likes of Stake. And we think that there is a significant pipeline that would be interested in Racing and Sports product and interested in racing. And we think it's very exciting for the racing industry. but we also think it's very exciting for a company like Racing and Sports. And then the third area, and again, I have no idea if Racing and Sports will go down this path or not, but an area that we think has great opportunity is that there are the people that make the money in the industry. At the moment, we see that you have the suppliers because they're getting a percentage of the gross revenue, and that's the area we focus on in Pillar 1. There are the new up-and-coming, they're called, let's say, crypto bookies, but they're far more than that. They're offering a different, unique user experience and acquiring customers in a different way. We think that obviously they're making huge money and growing significantly. And the third area is professional betting syndicates. So it's very hard, as you would appreciate, the listeners here, to win betting because you've got margin against you. And the bookies have that margin edge on their side. But there are groups around the world that can win betting on all different markets. And those businesses find it very, very hard to sell. And to sell at large multiples. And Racing and Sports is a very unique business in that it has amazing data capability. Gary Crisp has run a proprietary database for a long, long period of time. And we believe that there's the ability for Racing and Sports to look at those businesses. And if they can run those businesses or assist those businesses in some way, there's plenty of businesses that are syndicates that are trading at very low multiples and need assistance in growing and the capability. Whether Racing and Sports want to even look down that path, we're just interested because they have the capability if they were ever to look. And it's nice to be involved and have an option deal and an equity stake in a business that's in an area that we know and think has great growth prospects and a very capable management team. So just to summarize, because I know there's a stack of questions and I probably talked way too long in that. The first pillar is that we find options in suppliers to gambling companies, so tech suppliers to gambling companies. We option them up and find businesses that we think have a great ability to expand. While we're doing that, our capital base is in US equities, and we think conservative US equities that are owned by the leading funds, long-only funds in the world. And then the third pillar is a strategic equity stake in business, Racing and Sports that is an area that we know very well, and we think that we are complementary to them and they are highly complementary to us. And that is Waterhouse VC. We only run one fund. I hope I'm doing this for the next 20 years. I love doing it. The family's the largest investor in the strategy in the fund, and it's an area that we know well, and I just believe that basically if we keep our head down and keep finding option deals over the next 20 years, we're going to perform well. If we suddenly can't have the ability to find option deals, then we're a very stock standard, conservative, boring US equities fund. And I always say to our investors, we've got monthly liquidity. If you're not seeing the constant deal flow of option deals coming through, well, you can probably find an equity strategy somewhere else or do it yourself. And that's our fund in a nutshell.
Great. Thank you, Tom. So just to quickly sum up before we go to questions, the fund is currently open to wholesale investors. We have monthly unit pricing so that you can come in and out on a monthly basis. And if you'd like to make an investment in the fund or just learn more or have a call with us again, just contact me. My details are on the next slide. And I can give you a copy of the information memorandum and the application form. So we'll move on to questions. We've had a few come through in the chat box and also a few come through beforehand. I might just start on a couple around the option deals, Tom.
Yep.
There was a good one earlier from Ben. It's a very good question. Can you explain further why the technology suppliers are happy to sell you options to buy a large proportion of their business at such a cheap price? They only receive 30K or less in cash, so how do they benefit?
Yeah, it's a good question. So the reason being is the option strike price in 3 years' time, we don't negotiate hard on. We basically say, well, what do you think is a reasonable value for 3 years? So let's say they're worth $1 million in their mind now. they might say, well, look, I'm happy that I get to being worth 10 million or 20 million in 3 years. And as long as we agree the strike price is 10 million or 20 million valuation, and we think it could be much bigger than that, then it's value for us, in a sense, the option. And they're like, I can't believe we're only worth $1 million now. It'd be amazing if we get to being worth 20 million in 3 years. So yeah, we're only paying a small amount for the option if they come off, but there's so much like risk and other things come into play from them going being a $1 million company to a 20 million plus company. And we only have value in our option if they go to being a 40 million or whatever plus company. So it's, and for them, I know with tomwaterhouse.com, I knew the area was growing. I knew that online betting was the future, but I had no blueprint. I knew it was an on-course bookie. I had no blueprint of how to go from being an on-course bookie to how to being a large corporate bookmaker. And I always say that, look, we paid to learn in a sense, but if I got someone that had gone, oh, well, actually, I've done this for the last 10 years in the UK, and this is the blueprint of how you acquire customers, onboard customers, retain customers, how you operate the platform, the suppliers you get, the deals you work, all of this insight. And we don't take active management, but we do provide insight and credibility, and we do a lot of work. If we're going to go and do a deal with an esports data supplier, we don't just go and do the deal with the first one we've looked at. We go and see them all. Like we go and see, like we've gone and seen like esports data suppliers in Eastern Europe, in Prague or in France or in the UK, or we speak to them all. We speak to who they're supplying, who they supply to, what are their service levels, what are their uptime, how good are they to deal with. We get a deep understanding. So for us to do an option deal, it's not, as I said, we do 20 calls a week, and we probably don't do an option deal with any of them. We're doing a lot of work before we even do an option deal. So yeah, it sounds like it's not expensive if it's 30,000 or less, but like it's a great outcome if it comes off for us, and a great outcome for them if it comes off. And that's the benefit I believe we bring. I hope I summarized it well enough.
There's another question around the option deals that came in during the week from Dan. At which point does your fund get to a point where you see volume issues in your market? I don't think there's any sort of limit on the strategy of implementing the 13F portion of the fund, but there's certainly a limit at some point, Tom, around where we can do enough option deals to add alpha to the fund. Do you want to comment on that?
Yeah, no, it's a very good question. And we think about it a lot because obviously the family is the largest investor in the strategy. So we are around $75 million of FUM at the moment. We're planning to close to external investors at 200 million. And we think that the reason being is exactly that point, that if we just leave it open forever, it basically becomes a 13F equity strategy. And for us to have hopefully outperformance, significant outperformance from the market, we need to focus on the option deals, and the option deals being significant enough that it gives us that outperformance. Our sweet spot is doing option deals with companies that are sub 100 million. A company that's already $1 billion, they're already got all of the team and know the people in the industry or whatever. We really focus on the smaller end. It can be listed or unlisted, but we see that yeah, to external investors at 200 million. And we think that the strategy basically blends into a 13F strategy once you're over $1 billion in funds under management.
We've got a couple of questions on the minimum investment. So we had one earlier in the week from David, what is the minimum investment amount? And then one earlier on the webinar from Luke, why is the minimum investment 500,000? I can probably take that one. The reason is that we're an unregistered managed investment scheme. So there are some rules here in Oz around what you can do there. The rules are around sophisticated and wholesale investors. So one way you can meet that test is by putting in $500,000. The other way you can enter the fund is just by qualifying as a wholesale investor. So you've got to get a letter from your accountant or your financial advisor, and with that letter you can make an application to the fund. Anything to add there, Tom?
I think it's if they're putting less than the minimum, it's worthwhile looking up those wholesale investor requirements, like what the asset you need to have and the income you need to have, and so on.
Yep. One just came in from John. What's the watermark that you use?
So in terms of like a high watermark, in terms of whether you take performance fees and management fees, yeah. So in terms of once you've hit that high watermark of performance, there's no performance fees until you're over that watermark again. So if we have some amazing return, well, yeah, that's fantastic, but you're not getting fees again until we get over the return that investors have to have made money for us to be back over that watermark again. So yeah, it's great incentive for us. Obviously, I assume all funds are the same. The great incentive for us, we've got to keep getting good return if we're expecting to get performance fees.
Right. There's just a question from John. Hi, Tom. Thanks for your presentation. Could you please provide an update on the professional tennis betting syndicate? Thank you. And then there was also another one from Liam. Are you seeing any opportunities to invest with sports or racing wagering syndicates? Probably
Yeah,
take
okay,
both of
yeah.
those.
No, it's very interesting. So as I touched on earlier, it's really hard to win betting because you might be able to, if I don't know, if South Sydney's playing the Roosters, you might be able to have a really good gauge on who's going to win that match. You might follow both teams really well, understand who plays better in certain weather, when a certain player's out, niggling injuries, whatever. And you might say, well, look, the bookies have just underestimated how well one side's gone. They've priced it incorrectly, and I'm betting. And that is a strategy, and you can be a winning punter with that strategy. The issue is that it's very hard to know that detailed information for hundreds of games and events and betting opportunities. And so if you bet regularly and you don't have that insight and detail of what the true odds should be, the bookies have margin against you. And so it's not that the bookies know what the true odds should be. They're working off supply and demand, a weight of money, and also in building margin into both sides. So they've got a margin against you. It is possible to beat it, but it's very hard to beat it if you don't have more intel and knowledge of data and what the true odds should be than the bookies. There's a few groups around the world that have built data models and have large teams of people around the world betting on horse racing, boat racing, bicycle racing, all sports, financial markets, and so on. And they win large amounts of money, and they are betting into it's $1 trillion market. They're betting into $1 trillion market and have the ability to assess what the true odds or true probability is more often than the market can. But most people that come to us and say they can win betting, we normally think that they've had just a period of positive variance, diluted, or just like con artists in a sense. It's basically very, very hard to win. But we came across a young guy who was ultra amazing to speak with and had such insights and had been very successful for quite a few years betting with the bookies. And I'd heard that he was very, very hard to beat. And I met him and thought, well, gosh, he sounds ultra intelligent, very interesting. And our team spoke to him in more detail and said, well, give me an understanding of what you do. And it's not really our strong area of expertise, but we have several of our investors that are in this space and people I know in the industry, and got them to speak to him, and they're like, he's ultra switched on. He said, look, I used to work for Tony Bloom, who's owns Brighton Football Club and got an award from the King earlier this year, and is probably the leading soccer bettor in the world. And he said, I used to work for him. I called Tony and I said, look, is this guy good? He goes, yeah, he's excellent. Very, very switched on young man. And yeah, he's very talented. And so we did an option deal to be able to acquire 10% of his betting syndicate at a £5 million valuation. And he has had amazing success. He's been able to triple turnover and gross win every year for the last 3 years. And we were able to convert our option at less than 1 times earnings in that business. And yeah, it's been for our investors, it's been a great outcome, and made us realize that these syndicates are quite complementary to each other. And so that's why we thought there may be an opportunity. Again, I don't know what racing and sports, if it's in there, they've got obviously a million opportunities on the go, but we think there's an opportunity, and we've done 2 other option deals with professional betting syndicates structured in a way that's very advantageous for our unit holders, but hopefully also for them as well. And we think they trade at much lower multiples than other players in the industry, and have a unique edge and very interesting. And so we've done 2 other deals in the space. One is actually a racing professional betting syndicate. One is in the gaming space, and it's an area that isn't really looked at by other funds in the sector, but is an area that we have growing expertise in, and definitely think that there's more growth opportunities.
Got a question from Damien. How do the number of promising option deals that are coming to maturity in this financial year compare to previous years?
Yeah, it's really interesting in that you just sort of don't. At the beginning, I'm like, well, we're just a one-hit wonder. We're doing that one deal. What are we going to be able to get other option deals? And our first few option deals we did after that first good deal, we're like, oh, let's just do some option deals because we've got to get a track record of doing them. And they were just more like us. Oh, would you do an option deal with us, rather than us being very, very selective? And what we've found now, we've got a great rhythm of getting inbound. We've got a great rhythm of getting outbound to companies that we see like that's very exciting. We've obviously expanded the team greatly internally here. And we've got a rhythm of going to all of these conferences and speaking at them where we're known in the space, and we meet so many of them. And also because we've had success in the sector, they often are coming to us a lot more now. And we write a monthly newsletter that goes in goes in all the leading gambling publications. So we feel that we've got great deal flow. And so our option deals are coming through far more regularly now, and I think far better quality than they have ever been. I don't know, Michael, you probably have the exact figure of what we've done in the last month or weeks or few months, but it's definitely in a very different capacity than what it was.
Yeah, I think we're at 6 new deals added to the portfolio this calendar year. So maybe it's 5 or 6. So yeah, it's a pretty good sort of pace of adding potential upside to the portfolio, I think.
I agree. Thanks.
From James, do you see growth opportunities for investment in Asia, especially India, Vietnam, and Korea?
Look, we don't view it in that way, in a sense that we basically we want to find amazing tech solutions that solve an issue, and if they provide that, then we'll be able to get distribution in multiple markets. But what we do look at is if there's an issue in a market that is unlike another market. So for instance, in majority of states in the US, they don't allow iGaming online. And Australia, the largest gambling per capita in the world, doesn't allow sports betting pre-match online and horse racing online, but doesn't allow in-play sports betting or any gaming online. So those 2 markets are quite unique because they don't allow things that are allowed in other markets. So if we see a product that's specifically solving a solution for users and bookmakers in those markets, it's got a unique product fit. So India is a good example. There's a large proportion of the population loves cricket, and there's lots of different types of fantasy, different games that have got large databases. So we might look for something specific because it solves an issue, but we don't go, look, this geography, like let's say America is opened up, let's focus only on products in America. Because if you have a great, let's say, voice betting solution, well, yeah, you can expand it in America, but it's going to be also popular in Brazil, Australia, UK, and so on. So really it's product first. Does it solve a problem, and which markets does it solve a problem in, rather than this market's so big and let's find that solution for the market. It's normally the product led first, is how we look at it.
Yeah, it's sort of the benefit of focusing on the tech layer, right? Because if there is a market opening up, like Brazil's going to open up, then they can get exposure to that market without sort of being all in on a particular license there.
Correct.
So you get the exposure without as much risk, I think. We'll finish on one more question. A question from Mark. Are there any particular areas in gaming and wagering where you see AI making a major impact, such as virtual gaming or data analytics?
Yeah, look, definitely. Like it's really interesting, and we see it. I should just sort of more broadly is the benefit of the strategy that we look at is that we don't have to guess the future. We just have to see a lot of stuff and go, actually, that's amazing. That would work here. And then try and negotiate an option deal with it. So we don't have to invent the future. We have to just make sure we're constantly in the deal flow of what's happening in the future, which is much easier than trying to predict where it's all going. But AI is, and automation is, I think it's in every industry is just changing the game. And I'll just give an example in sort of professional betting. And obviously it's not my area of expertise, but we've done several deals in the space and know several of the key players in the industry, is that it all used to be about, well, getting the data obviously was one thing, but then modeling. So who made sure they kept the data in the most pristine measure, updated the model, had the model actually pristine, working great. What seems to have changed is that the actual modeling and computing of it all is far more automated now and easy for upstarts to replicate. What's really important now is finding unique data that is hard to obtain. So, and looking at games or sports in a different way than that's normally cut up for the consumer. So racing, for instance, is all about, let's provide as much data as possible to the industry and participants so they can make the most informed judgment and they can do the form and all this sort of stuff. Well, there used to be great edge of just taking that data that everyone could get and then modeling it really well, where now it seems that through tools and AI, you can model it all. It's finding the data that isn't cut up for public consumption, everyone to use, and finding a way to look at it and view it that isn't just that you can put it into your AI modeler and so on. Again, there's probably far better examples. It's much easier to give an example when you're right in the weeds of something than me that's at 30,000 feet looking on. But for us, again, we're taking that 30,000 foot view of all these businesses and just trying to find the person that's doing the latest innovative thing that is going to be adopted. But I would have thought it's going to be a game changer and yeah, obviously huge opportunity for those people that are adapting and providing something unique.
Great. Thank you, Tom. We're going to look to wrap it up there. We're coming up to about 55 minutes, so I think we better let everyone go on with their busy days. If you have asked a question and we haven't had time to answer it, we'll come back to everyone individually, and then obviously look to hold a few more webinars over the coming months. But otherwise, thanks for your time, Tom, and thank you everyone for joining.